see. Well, let's get more on how that could impact our market. Live now to Michael Wayne from Qatari Securities, joining us in our Sydney CBD studio. Michael, first and foremost, just your thoughts on Yellen's speech. What did you take from it today?
Well, the Federal Reserve certainly have a bit of a balancing act on their hands at the moment. On one hand, they're looking for some inflation in the economy, but on the other hand, they want to be sure that the inflation doesn't spike unexpectedly, because the ultimate risk, I suppose, for the Federal Reserve is if they leave it too long and inflation does spike, they'll be forced to increase interest rates at a quicker rate than the market's anticipating and than they're anticipating, and that would cause significant jitters around global markets. I suppose what I took out of it was, look, she thinks inflation at the moment is being subdued by the US dollar being so high and by oil prices being so low. And that's probably true to an extent, although I will point out we've had very low interest rates for a very long time and inflation hasn't reared its head just yet. So to assume it will in the next sort of 12 weeks or so does remain to be seen. I suppose one thing they could be looking at is the median inflation rate. Although the core inflation rate, which is the headline that we keep hearing about, is below the trend line, that median rate, which takes into account or excludes the higher items and the lower items from the inflation basket, that's significantly higher than the core rate. So they might be taking that as a sign that inflation is beginning to rear its head. I think there's also an established train of thought at the moment within markets that the real economy isn't really benefiting from zero-bound interest rates anymore. Companies are hoarding the cash, they're paying out dividends, they're buying back shares, and savers are really being disincentivised. But ultimately, I do think, although the first interest rate is very important, it's really the second, third and fourth interest rate rises and the timing and the rate of those increases that has the biggest impact on asset prices and debt pricing as well.
Does her commentary overnight also suggest that some of the fears about a slowing China have been overblown?
I suppose so. They're looking to temper that a little bit. Basically, look, that China thing, sorry, I just lost my train of thought. That China thing was being blown out of proportion significantly. It is certainly definitely a risk on the horizon. China do have a lot of ammo up their sleeve, but I think the speech that we saw from Yellen today was just tempering those fears somewhat. They probably would have increased rates this time around if there wasn't those emerging market fears. However, they think that that's probably been overblown. They're saying that they're not, although they are cautious on it, that's not going to be the ultimate determining factor for them going forward.
Can we get your reflections on the session underway? Final trading day of the week. Poor offshore lead-in from the United States. At the moment, the ASX down about 17 points. Material space not looking too bad, but losses being led by the banks and the energy space today. Just your thoughts on where we're tracking, I guess, now towards the close of the session. Yeah, look, we shot out of the gates earlier today. We've sort of settled back a bit. I do think around this level, this 5,050 level, is probably a natural level of support for the market. I mentioned yesterday the dividend yield in the market at the moment is very, very attractive, particularly when compared to the 10-year government bond rate. So I think, providing we don't get a spate of bad economic data or we don't get a bad third quarter results coming out of the US, the market has probably sort of found a bit of a bottom around here. That's not to say we can't go lower. There certainly is that risk there. But I think at the moment, barring no more bad news or no more uncertainty coming from overseas, this is quite a decent level for the market around these levels. Can we get your thoughts as well on talk that Caltex is considering a takeover of Woolworths? Is this real?
I think it's more a takeover of Woolworths' petrol station assets. I don't think it's Woolworths overall. Look, that makes sense from a standpoint, strategic standpoint for Caltex and Woolworths. Caltex can run the petrol stations, Woolworths can supply the food and the drink. But overall, it makes up only about 1% of Woolworths' earnings. And I've come on this show a number of times, been asked about Woolworths a number of times, and there's no real silver bullet for Woolworths. Whether they sell Masters or whether they sell their petrol station assets or whether they spend $60 million on upgrading the stores, for them, the fundamental and core issue at the moment is that their grocery business is losing market share. Foreign entrants such as Audi, such as Costco are coming into the market, eroding their margins and putting down pressure on their profitability. And look, at the moment, that consumer staples space, we're a bit cautious on at the moment. We'd prefer to focus our attention elsewhere where there's a bit more sentiment and a bit more positive momentum than what we're seeing in that staples space at the moment.
So where else are you looking?
Look, we like the conservative healthcare, defensive healthcare. There is still some growth in that healthcare space. As I mentioned before, CSL Limited, Cochlear, Ramsay Healthcare, these established players in the healthcare industry. We've got diversified earnings streams overseas. They benefit from the falling Australian dollar, and they also benefit from not only the ageing population, but emerging middle classes as well. So in this sort of environment where the market is jittery, you want to go for some defensive plays, but at the same time, these offer a bit of growth in them as well. So rather than things like consumer staples or miners where the momentum and the sentiment is significantly against you, we'll prefer to focus our attention where the long-term demographics certainly make sense.
And Michael, in terms of trade direction for next week, what's on your radar? What are you expecting?
Look, at the moment, with the volatility that we're seeing and the broader negative sentiment that we're seeing, we're looking to focus on companies that have specific events coming up. That way the market focuses on the fundamentals of the business rather than the broader market sentiment weighing on it. This week for us it was TPG Telecom. That turned out to be a positive thing, outperforming the broader market, hitting all-time highs in a market that's sold off significantly. Next week there's not so much on the radar, but looking forward into October, the next stock that we're looking at specifically is Certex Medical. Looking forward to their AGM. I think it's around the 20th of October. And we expect in that AGM they might even come out and upgrade their sales target for the year ahead, because essentially they've had that SurfLock study in the pipeline for a while. They've gone out now and hopefully marketed it to a number of different oncologists around the world. So they'll get a much better idea of exactly how much their dosage sales may increase for the year ahead, and we're expecting some fairly positive results or fairly positive outlook statement coming from Certex.
Michael Wayne, we'll leave it there. Thanks for joining us as always.
No, not a problem. Thanks for having me.